Ladies and gentlemen, my name is Greg Mikulowski from ForexLive.com. Today's day is October 28th, going into the 29th. This is a Forex Technical Update. I'm going to look at five currencies in 6 minutes. Before I get to that, let me remind everybody that the FOMC interest rate decision is less than 24 hours away. Adam Button has put a great FOMC preview on our website at ForexLive.com. Go, be aware, be prepared, read that from a fundamental perspective. He says it all. Let's take a look at the sterling versus US dollar. To start off, we're seeing the market move to the downside here in the last 20, 30 minutes. Why? Because Bank of England's Cunliffe came out and said that the BOE can keep stimulus longer than previously thought. Cites softening in UK pay, inflation data, sees evidence of slowing in UK growth as well, and that is sending the pound sterling back to the downside. We also came up to topside trend line here, and also the high price going back to last week's trading, October 21st. Couldn't get above each of those levels right at this level, and that also contributed to the downside momentum. But it really wasn't until the Cunliffe comments here that sent the price further to the downside here. Testing a level right now, or an area right here, 161.25 to 30, where we had a high right here, we had a low right here, we had lows right here, we had a high right here. We had highs even early today in this area right here, this yellow area right here. So this should be support for the pound versus US dollar. If it goes below this level, look for a later test of the 200-hour moving average and 50% retracement of last week's move to the downside. Earlier today, the market went right down to that 200-hour moving average and bounced, so that market will remember that level, remember the 50%, remember the 200-hour moving average, and look for support down there against that level. Let's take a look at the euro versus US dollar next. And this currency pair, also speaking of 200-hour moving averages, found support against a 200-hour moving average. It also found support against a trend line right here. Remember, the pound was using a trend line on the top side. This is used a trend line on the downside. So earlier today, when the market went down, tested that trend line, the market bounced off that level, moved above the 200-hour moving average, went above this 46 to 57 level. I'll talk about that in just a second. And then we had a correction off of better than expected data, Richmond Fed manufacturing. Also, we saw the consumer confidence come out much better than expected, and that took the trend out of this move to the upside here, and forced the correction down to our support level against the 200-hour moving average. Buyers came in, forced the market back up to the 46 to 57 level, and that's where the market stopped right there. And why did it stop right there? Let's go to the weekly chart and take a look at the lows from 2013. This level comes in at 46. This level comes in at 57. Remember, on the hourly chart, this is 46. This is 57. We actually moved a little bit above the 57 level right here. But the market, that's right before the market said stop right there on the day, and the market moved down right there, and so that's where we sit. So going forward, a move above the 57 would be more bullish here for the euro. A move below the 200-hour moving average would be more bearish for the euro. Look for dip buyers against the 200-hour moving average. Again, just a hunch before the FOMC. Let's take a look at the dollar versus yen next. And off the dollar versus yen, what do you see here? Well, I see a nice little trend line connecting a number of different lows right here, and I also see the 100-hour moving average. That's a blue line in this chart. Now, if I zoom in here and take a look at that 100-hour moving average and that trend line, I see that the market went below those two levels. That was off of the weaker than expected data before the consumer confidence and before the Richmond Fed came out. That weaker data was the durable goods orders and the case shilling home price data sent the dollar versus yen below the 100-hour moving average, not just once, but on two separate hourly bars, and the market couldn't sustain that sell-off, and it started to rally back to the upside. Got the better data, that helped out as well, but we were contained here. We have a double top at the highs. We have this area right here that's going to be support. This is resistance. This is support, either here or we're going there. Not made to be dependent upon what happens at the FOMC tomorrow afternoon. Remember, for the dollar versus yen, it might be a little bit tricky. Why? Because if the Fed extends out not necessarily the quantitative easing, they're going to get rid of that, but extends out the time that they have, or is more dovish, okay, then that may also be bullish for the stock market, which could be bullish for the dollar versus yen, although remember, we're not going to have any more quantitative easing. It's going to disappear tomorrow, so be aware of that. So just watch the technicals. I think the technicals are going to tell our story tomorrow. I'm not going to have a position going into the dollar yen into the FOMC. That's one currency I would not be messing around with. One currency currency I like is the Aussie versus US dollar. Why? Because we're breaking outside of this box. Remember this, this has been consolidating. This is a really ugly chart, isn't it? We did have a failed break to the downside. Remember last Friday we thought we were going lower. Nope, came right back, and we came right up to this top side yellow area where we have a number of different highs here in this area right here. Now we had a couple times where the market broke above, like there's one, there's two, and here's the third one that happened in trading here today. We broke above this 88.33 level, and the market's been able to, for the most part, stay above that level, haven't we? And so we're getting out of this forest right here, this forest with lots of bars. We're moving into greener pastures right here where there's not a lot. There's open space, and so we're in open space now. The idea is now, do we continue to trend? Do we continue to trend to the upside, or do we take out the 88.97 level on the top side and move higher away from the 100 and 200 bar moving average, away from this forest? That's what I'm betting on for the Aussie versus US dollars, is we stay above this yellow area. You have to make that bet. You have to say non-trending leads to trending, and we're going higher. That's the way I'm positioning the Aussie versus US dollar. That's the way I like it. New Zealand versus US dollar, maybe a different story. We have a Reserve Bank of New Zealand interest rate decision coming up tomorrow at 4 p.m. Eastern time. That is going to dictate what is going to happen to the New Zealand dollar. Remember, the Reserve Bank of New Zealand has been warning that the New Zealand dollar is too strong. Now, it has come down since its last meeting, which was on September 10th. That September 10th was right around this day right here. So the New Zealand dollar has come down further, but we've been consolidating here in the October month. We had trade data that came out weaker but stronger because it was a bigger deficit, but we had all sorts of aircraft orders and higher imports and exports, so it was kind of ambiguous. We also saw inflation come down more than expectations, and that sent the price below this trend line in last week's trading. But since then, we recovered nicely. Watch this 200-hour moving average. Watch this 50% retracement level. If it goes below that level, I'd be more bearish on the New Zealand versus US dollar. Keep that level in mind. 50% 200-hour moving average, 79.13. So there you have it. 5 currencies in 7 minutes. I lied. My name is Greg Michalowski for ForexLive.com. Good fortune with your trading. Bye-bye now.